I'm not going to make you wait till the end of the video. The best stocks to buy for 2026, according to my research, include The Trade Desk, Pinterest, Adobe, Meta Platforms, Lululemon, Amazon, and Visa. Now, I'll go through each one of these and describe why I think these are undervalued and excellent stocks to buy for 2026 and beyond. So all of these companies are companies that I've been researching for several years, and I've calculated discounted cash flow valuations on each of these. This is my own proprietary model that I utilize to calculate a fair value of the business. Starting with Adobe. So I calculated Adobe's intrinsic value or fair value per share to be $411, and the current market price for Adobe is $353. Adobe stock experienced a difficult year in 2025 as investors were concerned about the company's investments in artificial intelligence not being enough to keep up with competitors that are innovating more rapidly and the potential impacts to its business. Now, I agree that those are risks that Adobe stock investors should consider, but those risks are already priced into the valuation of this business. And I think from this point forward, there's a good risk versus return for Adobe stock investors. Lululemon is another business that experienced a difficult year in 2025, especially as tariffs impacted its United States business. Revenue growth in the United States slowed considerably, but the company's international growth is offsetting those declines in the United States. The intrinsic value per share I calculated for Lululemon came to $271, and you can buy Lululemon stock for a little over $212 today. I believe Lululemon's longer-term prospects are excellent, and the higher-end consumer is faring much better than the lower-end consumer, and Lululemon caters to higher-income consumers, which are experiencing better economic performance compared to lower income households that are feeling the pressure from increasing cost of living and increasing tariffs. Meta Platforms is another business that faced increased scrutiny from investors in 2025, but this was due to the company's increased capital expenditures or increased spending on data centers optimized for artificial intelligence. Investors are concerned that Meta is spending too aggressively in this category and not making enough progress. The company's stock price has not performed as well as other AI companies that are spending similar sums. The intrinsic value per share I calculated for Meta came to $739 per share, and the current market price is $659 per share. The next on my list of top stocks to buy is Amazon, which also experienced a less than stellar year in 2025, again due to the rising impacts of tariffs and the company's aggressive spending on artificial intelligence. Its capital expenditures turned out to be 25% or roughly $25 billion more than it was expecting. Now, some investors saw that as a bad sign, but I actually saw that as a good sign. When I'm evaluating a company that I feel has a strong management team, and I see that management team allocating more money to a certain category, I'm generally optimistic about the results, about the potential return on that investment if that management team has proven to me that they are effective allocators of capital, which I do believe Amazon's management team is effective allocators of capital. The intrinsic value per share I calculated at $270 is well above the company's current market price of $232. Next on my list is Pinterest, which I calculated its fair value to be $75.67, and the current market price is near its 52-week low at $25.88. A lot of investors are skeptical that Pinterest is harnessing the power of artificial intelligence effectively, and a lot of consumers have complained that Pinterest platform is full of AI slop that the company is not doing enough to control. But Pinterest is increasing social media accounts from the very lucrative United States region, something that not all social media companies were able to do in 2025. Furthermore, I'm extremely bullish about the advertising industry going into 2026, and especially the digital advertising industry, which Pinterest participates. The company's revenue compared to the total addressable market size, compared to how much money advertisers will spend, is relatively small, leaving it considerable upside to grow into this massive opportunity. The next company on my list also benefits from the growth in the advertising industry, especially the digital advertising industry, and that's The Trade Desk, which is also trading near its 52-week low at $38.39. The intrinsic value per share I calculated is just over $65 per share. Interestingly, the Trade Desk stock price is trading near its 52-week low, partly because of competition from Amazon, which is expanding the products and services it's offering that compete against the Trade Desk. Also, a shuffle at the leadership positions near the top of the Trade Desk's leadership team has investors concerned about the company's trajectory and especially their prospects going into 2026. And last but not least, Visa. The intrinsic value per share I calculated for Visa is over $480. The current market price is just over $354. One of the reasons why I'm bullish about Visa is because it's one of the most profitable companies in the world with an operating profit margin over 60%. I also like the limited competition between itself, MasterCard, and others in the industry that don't fight against each other so aggressively, and that's what allows industry participants to generate such lucrative profit margins. Another side benefit for investing in Visa is you get some exposure to inflation protection because Visa generates revenue on a percentage of the total transaction value on most transactions utilizing a Visa payment processing system. And so if people are spending more money on the same things, that lifts the company's revenue because it generates revenue on a percentage per transaction basis. And so I expect inflation to be above trend for 2026 and for 2027, and investors are going to grow more concerned about inflation, especially because President Donald Trump is pressuring the central bank and the Federal Reserve in the United States to lower interest rates while inflation is still well above the 2% target. So as investors get spooked about inflation and about inflation getting out of control, it may create an increasing sentiment among those investors that want some protection, and Visa is a great place to get some protection at a great price with a stock that's undervalued at the current market price. By the way, all of these discounted cash flow valuations are available to channel members at the investor tier or above. I have hundreds of these discounted cash flow valuations for companies, and I update these regularly on a daily basis. I'm updating multiple discounted cash flow valuations, keeping them up to date for all my investors in my member community. So I shared with you the valuations of these companies based on my proprietary discounted cash flow valuation models. But these companies also look undervalued when I look at them on a market multiples basis. So you look at the forward price to earnings of these companies that I highlighted. The most expensive of these is Amazon, which is trading at a forward PE of 31. The second most expensive is Visa, trading at a forward price to earnings of 28. And there are 4 out of the 7 companies I highlighted as the top stocks to buy that are trading at forward price to earnings of less than 20. Remember, the average stock in the S&P 500 is trading at a forward price to earnings of over 23. So these are undervalued both in terms of their historical standards, undervalued when I measure them based on my proprietary discounted cash flow models, and undervalued when I compare them against the S&P 500 index. So I'm curious to hear which of these 7 companies you own, which of them you agree with, which of them you're interested in buying. Personally, I own several of these stocks that I mentioned, and I'm interested in owning all of them.